Let's kick it off. Thanks for joining us this afternoon, this morning, this evening. We've got folks from 10 different states, 3 different countries, and like 3 or 4 time zones. So as we expand our presence, we appreciate people taking time out of their day. We realize there are a lot of folks out there putting timely and insightful content, and the fact you've given us an hour or so of your time is much appreciated. We're going to spend time recapping, Q2, right? Here we are almost in August, so I know that seems like ancient history, and then some of the outlook for Q3. Nice thing is we've got a month in our belt, so I can kind of predict what the market's going to do in the third quarter, at least up till June 27th, July 27th, excuse me. We're also going to head in a little special announcement, right? So you see again a new face. I'm excited to announce, Tom Mullen joined us earlier this month on July 11th, the easy date to remember. I've known Tom for over 20 years. Our lives have intersected both professionally and personally for going on 3 decades now. So Tom, he'll spend a moment introducing himself when we get to his part of the presentation. We're not willing to let him take an event in from the sidelines. We're going to throw him right in the fire, and he's going to take some time to go over international markets and fixed income. We're going to try to keep this to an hour, but at the same time, again, we do realize that there's quite a bit of content. We'll try to push this content out to you in a matter of a week or so. We wouldn't really send the recordings off. So, Maddie, why don't we hop to the agenda? I'll spend a couple minutes there, and then I'll turn it over to you.
Great, let's do it. Give me 1 second here.
Take your time. It's funny when we're doing our work on the preparations for the slide, some of these slides for the presentation, it's seems like some of the stuff happened months, if not even years ago. With the second quarter, a couple of really interesting things took place, right? I would describe the debt ceiling as one of those things that we probably spent a good 6 weeks or so on, leading up to a resolution at the 11th hour. No surprise, but again, positive second quarter, right? Pretty much anywhere you looked, which is nice to see. We had a little bit of a good start to the year, and then somewhat derailed by the banking crisis. Again, JP Morgan bought First Republic out of receivership in the second quarter, and Jamie Dimon, as he's been prone to from time to time, had come on CNBC and said, "Hey, this part of the crisis is over." We hope that's in fact the case. We had thawing relations in China, which is kind of good to see. Blinken was there, and Yellen's been there as well. And then we've got some what I might describe as interesting events with respect to Supreme Court, with the student loan forgiveness being thrown out, and that'll likely mean repayment start as early as October, and how that might impact the consumer or retail spending. And then there's some outstanding issues that continue to be worth worrying or worth watching. Excuse me, could be more worrisome when it comes to commercial real estate. Again, I'll spend some time with you on that. And then China has not exactly picked up as we'd expected post-pandemic, right? Their lockdowns really ended in the fourth quarter of 2022, and everyone's excited about what 2023 entailed, and it's been kind of a sloppy or a bit of a churn there. And then Europe is unfortunately mired in a bit of recession on the back of those higher energy prices. Again, could have been a lot worse, but things have slowed down a bit there. So I'm going to turn over to familiar face, Maddie, again, who's the host. She's going to take us through the macro. Then I'll dive into conversation really about U.S. equity markets. As I said, Tom will spend some time on overseas stocks as well as bonds, and then we'll wrap up with some investment themes. So again, thanks so much for the time. Maddie, the floor is yours.
And we promise to keep Jeff to an hour today. So please know that we will be taking questions at the end. So if you have anything as we're speaking here, feel free to jot it down and throw it in the Q&A box. And we will be taking those questions at the end here. So first, let's start with the economy, and we will take a look at the labor market. So we'll begin here with unemployment and wages. And we want to take a picture at the overall, or we want to take a look at the overall employment picture. But the past 50 years, unemployment, which is that lighter gray line, has been at an average of 6.2%, while wage growth, which is that blue line, has been at 4%. And you can see that they tend to have an inverse relationship. High unemployment is usually the result of an economic downturn or recession. Right now, unemployment remains below the long-term average at 3.7%. Wage growth also above the average, sitting at 5%. So this slide or graph here would really indicate the market is on solid footing as of right now. And then we'll take a look at the labor demand next. And this is a slide looking at the jobs opening and labor turnover numbers, or the JOLTS reports. 2 years ago, there was a big headline, and it continued to stay sticky for a bit, that the labor market had 10 million plus job openings. And today you can see that there's still around 10 million job openings. You can see this from the graph on the left, showing us the total openings from 1972 through April of 2023. And then the historic recessions are indicated by the gray bars. Job openings came down before and typically tend to bottom out, during a recession. We can see in March of 2022, job openings peaked at 12 million and have come down slightly to just above 10. And even still, job openings are higher than the past 6 recessions, bottoming out between the 2 and 3 million level. And then you can see from the top right graph that these quote unquote great resignation might be coming to a close, as total non-farm quits is coming down slightly to 3.7 million from post-pandemic highs of around 4.5 million. The bottom right-hand corner of this graph tells us that layoffs are still historically low at 1.5, whereas the past 3 recessions, they've been almost at or above the $2.5 million number, the 2.5 million number, again, indicating that the labor market is still relatively strong here. And we'll look at earnings, with a strong labor force, we wanted to see if that's actually benefiting wages. The top graph shows the average hourly earnings from 2009 through the present and nominal numbers, versus the bottom graph shows you hourly wage growth after being adjusted for inflation. And we can see that the US real average hourly earnings year over year, adjusted for inflation, was negative in the 2 years between April 2021 and April 2023. If you look at average hourly earnings, they've logged a steady increase at 5.7% lower than its all-time high and equal to February 2020 levels. And if we look at this, the question really becomes, will employers continue to feel the need to dramatically increase earning if inflation softens? And then as a close to sort of looking at the overall labor market, we wanted to look at the labor force participation rate. And the unemployment rates have flirted with record lows this year. The labor force participation rate has been falling since 2000, and hasn't really retaken pre-pandemic levels, sitting at around 62%. And if that number goes up, we can anticipate the job openings number to fall and unemployment to possibly increase. So if we look at business and consumer confidence, we've heard a lot about how consumers feel about the overall economy, but we wanted to get a pulse for how businesses are doing and feeling as well. So you can see that from the graph on the left, that small business capital spending in that darker blue have trended lower over the past year, despite a significant uptick as of late. And non-residential investment hasn't picked up as much as indicated by that lighter blue. And if we look to the right, retail sales and the lighter blue have been pretty resilient, but maybe susceptible to future weaknesses. Consumer confidence in the darker blue wanes, beginning, it's below where we would like to see it, especially as lending conditions continue to tighten. And then if we look at personal savings rates, so what does this all mean to people's pocketbooks? This slide shows us what savings rates were during the pandemic, where people saved $2.3 trillion, and what it's done post-pandemic. There was a drawdown of about 1.1 trillion. So essentially, we're back to pre-pandemic savings rates, which makes sense. We're a consumption-driven economy, but there's still $1 trillion in savings, pointing to, a possible excess of purchasing power. So now if we look at the US trade balance here, this slide shows the trade activity between the US and other key partners through March 31st of this year. The chart on the top shows that the US imports, which is in that red line, was virtually unchanged quarter after quarter. US exports, which is that green line there, increased 1.6% in Q1 of this year. This comes after a divergence of trade imports versus exports, bouncing off its lowest US trade balance ever recorded in Q1 of 2022. The bottom table shows how imports and exports have increased in all regions except Chinese imports, which slumped 21% year over year. Overall exports increased the most in the European Union, probably not too surprising there. Specifically, goods exports increased 17% in the EU, while services exports increased 32% in Canada. Improved manufacturing exports is definitely good for the labor force and increases resilience in the supply chain. Overall exports increased the most in Canada, being at 14%. Goods imports increased 13% in both Canada and the EU. Services increased 25% in Mexico. And you can see that there's still a large trade imbalance all over the world going back to the 1980s. We really start to see a divergence specifically with China once they entered the World Trade Organization in 2001. So now we'll begin talking about everyone's favorite topic over the past 2 years, which has been inflation. So you can see that the service sector is really driving a bulk of inflation. All the different sectors that make up CPI are in different colors on the left piece of that graph there, showing over a time period between 2017 and this year. And we can see that goods-oriented inflation is well off its peak, while services prices remain stubbornly sticky. Trends and leading indicators like money supply growth and contractions that you can see in the chart on the right in dark blue, while recessions are the indicators in the red there, are still favorable for continued easing and price growth, given how quickly the money supply has dropped since its dramatic increase that you can see in 2020. However, what's unknown here is how much the pace of inflation will decline. So if we look at this and then we take a look at this inflation heat map, which is something that we've shown in past quarterly market updates, this really tells us a story of where inflation continues to be sticky versus where it's coming down. And it's really interesting to see how this has changed quarter after quarter. So you can see that over the past 2 years, inflation picked up almost in all sectors, but the map is continuing to get greener, meaning inflation is coming down or cooling off as we moved into this year. Headline inflation, including food and energy, finished the month of May at 4.1%, while core inflation, excluding energy and food, came in a bit higher at 5.3%. But you can still see a dramatic shift in the energy and food sector as compared to a year ago. That's gotten a lot greener. Hopefully our wallets are all feeling a bit better at the grocery store, but inflation has definitely remained sticky in the core services sector, which is not too surprising given the fact that we know services are driving a bulk of the inflationary pressures still. And if we take a longer term view of inflation and zoom out, take a bird's eye view of what's happening, we can see that previous surges in inflation were associated with, definitely some unique events there. Some events lasted longer than others. More active monetary policies have been in place since the 1980s, although it's still uncertain whether the ultra-aggressive Fed actions can continue core inflation, can contain core inflation in the near term. Historically, we've seen higher inflation being correlated with, weaker stock markets and economic gains, but the COVID inflation surge that you can see on the map is still below some larger historical events and levels like World War I, post-World War II, and of course, the inflation of the 1980s. And if we take a look at how that's affecting things globally, we can see that global inflation has continued to be sticky, more so in the developed countries, as indicated in that dark blue line, mostly given the lingering supply chain disruptions and labor shortages, still being exacerbated by the war in Ukraine and commodity ripple effects from that. Inflation, what's interesting is inflation in emerging economies in the lighter blue is still relatively stable despite the dollar rally, which typically makes things more expensive for emerging markets. And we'll touch on that in a second. And everyone has been talking about the housing market here. So as we look at the graph on the top with 30-year mortgage rates ending June at 6.71%, coming down a bit from their highs of 7.08% early in the year. Because of that, it's not too surprising to see mortgage originations down almost 28% and refis down around 24%. This really comes on the heels of 2021 being the lowest 30-year mortgage rate in decades, hitting nearly 2%. So very lucky if you have that. Since then, mortgage rates have obviously shot a lot higher, causing mortgage originations and refinances to decline even further. So at the same time, we haven't seen home prices fall that materially, only being down, 0.25% year over year. Inventory is still very tight, and building permits continue to decrease.
Thanks, Maddie. That's great. Appreciate the update. Folks, again, I think it's pretty evident that we've seen, again, some moderation in the inflation rates, and actually we'll hear from Chair Powell later today. They'll make their announcement at 2 o'clock, and perhaps even better listening, or at least we're likely to move the market more than our call today, will be Powell and his press conference that kicks off around 3 o'clock. I wanted to spend a minute on what's become a somewhat more hot button issue when we think about the state of banking and perhaps what is the looming crisis in commercial real estate. Again, not convinced that that's necessarily a fact, but wanted to again highlight a couple things. So big banks, and I'd actually put a note out perhaps back in February or so, highlighting that financials looked attractive, probably a little bit early timing there. But I was talking more about the bigger banks in particular, and you can see that their exposure to commercial real estate is pretty small, right? Again, less than 15%. Local banks or smaller regional banks have much more exposure, and so there's a real reason why those stocks have taken out of the chin. Again, we'll monitor that closely. We do think that it's idiosyncratic, right? The issues seem to lie primarily with office. Good news is, again, death by Amazon has been a concern for retail for a long time, so that's not a new phenomenon. And multifamily housing, warehouse space, medical office, tower or cell tower property, like those real estate investments have actually held up pretty well. I want to just call out one thing here, which is important too, because of what's now a much more competitive marketplace, and this is in the lower right-hand corner, with respect to safe investments. We've seen banks which have benefited from pretty much free assets, right? The idea they've been able to have people put money on deposit and pay nothing in interest are now competing with treasury bills or money market funds paying anywhere from 4 to 5%. So we've seen those assets leave banks, go to the big financial firms like Charles Schwab and Vanguard and Fidelity, and that's created a little bit of agita on the part of the banks, where they have obviously concerns about capital reserves, and so that will impact lending, right? If they have less capital, or they're worried about their capital being flighty, it makes it harder for them to provide loans, whether it's small businesses or commercial real estate, so on and so forth. Maddie, if you want to hop to the next slide, we'll spend a minute on why we think that a soft landing is still in the cards when it comes to why this prospect or commercial real estate to be somewhat limited, especially in the housing side. You can see that income is still likely to be increasing over the course of the next several years when we think about multifamily, industrial, hotel, or hospitality. Office is where you're seeing some of these declines. I actually talked to a client this morning who was talking about making an investment. It's a family that's done a fair amount of real estate investing over the last 50 years or so, and they were talking about buying a mixed-use property is partially residential and commercial, and converting the commercial to residential. It's something that's been going on, or at least talk has been going on about that in New York. So again, I think this is very much manageable risk. This is not subprime. If you could look at the top, where you could see that mortgage debt outstanding was enormous, right? 76% of that was, residential, right? Where you had worries about, ninja loans, no income, no job applications, or zero down. Today, you can see much less exposure of banks, period, when it talks about mortgage debt, right? Whether it's multifamily, single family, commercial in the aggregate. So again, I think that we'll be able to weather the storm, but again, something we're monitoring. The dollar, right? Again, this comes up a little bit in the conversation about inflation. Maddie had highlighted how emerging markets have been benefiting a bit from, this year, at least early on, a weaker dollar. I know the dollar's picked up a little bit of strength in the last week or so, but at the same time, dollars down year on year, roughly about 2-3%. And so that ends up being a tailwind both for US multinationals who sell products abroad, right? They're selling things in euro and converting back to dollars, or yen back to dollars, but also takes a little bit of the stress off of sovereign issuers, right? Like if you're a Indian company or Indian government, you oftentimes are issuing debt in more stable currencies, i.e. dollar or euros. And so as the G7 currencies have weakened a little bit, that's made funding costs go down. So we'll continue to monitor the dollar as well. I think, again, the trend for the dollar probably over the next several years is likely down. I don't think that's necessarily a bad thing. Reason being is we're probably closer to the end of the tightening cycle, and the relative interest rate differential is likely to shrink. I mean, there's a point in time when the Treasury was considerably above the yields in most of the developed world. Now, as the developed world's played a little bit of catch up, you're not seeing as much of a spread there. And then on the trade balance piece, again, we talked about that before. Again, you saw that imports from China were down a little bit year on year. That gets a little bit to the tariffs and our efforts to onshore, reshore, friendshore. But again, if that trend continues, that's generally something that would actually have some positive effect on the dollar. So perhaps a bit of an offsetting effect of lowering rates at some point in the not too distant future. Probably first rate cuts will happen at some point in 2024. So again, that's a dollar dynamic. The last thing we're going to spend macro is just the leading economic indicators. And this is the one that has a lot of people scratching their head. So we've seen the LEIs contract for basically 15 straight months, right? And just like the inverted yield curve, any real consistent decline in the leading economic indicators is generally kind of a recessionary indicator. So it's important to watch that. Again, I don't know that it's perfect blueprint or path forward. The inverted yield curve has a pretty good track record, but things are bound to change. We've seen over the last 3 or 4 years stuff that's just totally unfathomable. Zero interest rates for $17 trillion worth of debt. $3-4 trillion of stimulus over the span of 24 months. So it's not unreasonable to think that some of these things occurring today aren't exactly great tells for what will hold over the next several quarters. Let's transition now to the equity markets. Just U.S. in particular is where we kind of focus our energy. We're in the midst of a 12-day winning streak for the Dow. Again, what Powell has to say at 2 o'clock or more likely 3 o'clock, we'll see if that continues to a 13th day. But we've done a really good job of retracing the sell-off that we saw in 2022. You can see the market as of the end of June basically was back to around 44.50. We're today roughly around 45.60. So the market's picked up another few percentage points here in July. We're about 5% away from the all-time high. Now there's some debate. I made reference to the fact that early in the slide that we're in a new bull market, having seen the market come 20% off the lows. Some people will actually say a new bull market can't start until we've eclipsed the previous height, which was back in January of 2002. But again, the trend has been our friend. I do want to call it the fact that a couple things to pay attention to, right? If you look over the course of the last several years, multiples are pretty full, right? We've got a forward multiple in the S&P of around 19 times. That's above the long-term average, close to around 16. And we're also looking at an environment where interest rates, like the 10-year Treasury at 3.8%, is pretty much higher than it's been for the last 10 or 15 years. So it does mean that stocks, in order to justify their higher valuations, are going to need to produce earnings in a big way. So we'll spend some time on that coming up. Let's get a little bit deeper here. Again, we talk about the market and kind of tend to, in our industry, gravitate towards one indice, oftentimes the S&P, but you can see here, and this is the second column from the right. NASDAQ was up 13% for the quarter. The S&P up 8.7%. The Russell 2000, the small caps, up about 5.2%. And then value actually had a decent quarter, right? Despite the fact that financials continue to be kind of a big, a focal point for investors at 6.6, but growth was up 10.6, so a difference of about 4%. Again, doesn't sound like a lot, but annualize that out, we're talking about a pretty big spread. And then you want to get a little bit further down into the sectors. You can see, tech continued to lead the charges, and then the proxies for tech, just consumer discretionary, which is where you'll find Amazon, or communication services, where you find Meta Platforms and Google, as well as Netflix, or Alphabet, I should say, were the top three performers. And we saw energy and utilities, actually bring up the rear with negative real return, or negative nominal returns for the second quarter. So again, a lot of participation. Like I said to you, looking at like materials as an example, a 3.3% quarter. Annualize that to 13.2%. It's a pretty good number, but again, looks pretty paltry when you look at the top 3 or 4 sectors on the list. I want to call out this concept of concentration. This is actually something that has been buzzworthy of late. The market's become very much influenced by a handful of stocks, right? You can see technology, in the upper right-hand corner. Apple and Microsoft together represent about 14% of the S&P, right? A very big part of the tech sector itself, but really, again, 2 stocks make it 14% of the S&P. 7 stocks account for roughly 25% of the index. So this is one thing that I like to allude to, right? When we invest for clients, we invest with diversified portfolios. There could be a scenario for the next 6, 12, 18 months where the S&P is flat, but you actually do pretty well, so long as you don't have your portfolio all in the S&P, right? It's important to have diversification. It's important to spread your bets out a little bit, and we'll talk some more about that momentarily. This is that concentration piece, right? So if you look at the left-hand side, right, 5 stocks at 25%, there's some history there, right? We've seen in periods in the Nifty 50s, or going back, even before that, to the days of the true kind of titans of finance, the Rockefellers, the Carnegies, and the like. But in modern time, we really haven't seen that much concentration, especially within one sector or kind of sub or category, I should say. Again, consumer discretionary and communication services are their own sectors, but really the big drivers of those sectors are technology companies, at least as I think about them. On the right hand side, you can see how much those 5 stocks contributed to the performance. Again, they averaged a return of nearly 100% since going back to 2020, whereas the market itself cumulatively up about 25%. So you could see that they drove a significant portion of the return. That's been the case very much so in 2023, but even really over the last 3-4 years. So again, concentrations, we talk about not wanting to have too much money in any one company. That same thing can be the case even though we have an index, which in theory has a lot of diversification there. Getting back to the sectors and looking at this from valuation perspective, which again something I really tend to gravitate towards. If you look in the column, that's the 4th over from the left. You see the Ford PE. Again, the market at 19 times is again a bit elevated. The column to its right is the median in the last 30+ years, which is kind of modern times. And so people say, what difference does it make what's going on in the 30s or 40s and 50s? And I do think there's some important analog to history, but in going back the last 30+ years, you can see the market generally is trading close around 17 times. And as you go through individual sectors, you can see technology is trading nearly 50% above its long-term average, right? Only in the instance of one sector do we see it actually trading at a discount for its long-term average, which is energy, right? Which was up 60% last year, but it's had a tough year so far here in 2023. The point I'd make is, again, like the valuations and stocks today are full, right? And so the notion of high double-digit returns for the foreseeable future is unlikely, unlike an environment where we may have seen in past instances where PE ratios were 10 times or 12 times. Now, again, if I'm a value investor, I might tend to circle more of the columns or rows where I see the PE ratio closer to its median. Again, it's just quite a bit of anecdotal data. That's not what the price that you pay. It's really about the value you get when you buy a stock. So let's hop to the next slide. and we'll get a little bit more into, kind of valuation. The book value and price to cash flow also suggest the market's a bit on the expensive side. Again, this is just the S&P, to be very clear. And so if you look at what we're doing with our clients is, we're trying to have ample exposure to the S&P and the names, but bring down our collective exposure there and increase the amount of exposure we have in companies that are less expensive. These are still quality companies. We're not looking to buy value traps. But when you know that in the aggregate, the market's not cheap, if we can incorporate some more cheap investments elsewhere, or somewhat more thoughtfully, that's going to just stack the deck in our favor two ways. One is that might mean better return going forward, or it also means like less downside. If you're paying, paying for perfection and you don't have everything break right, the right sizing of that stock's price can be pretty substantial. So again, continue to focus on valuation. The growth versus value trade, you can see, and I had a conversation with a client earlier this week, that it's been interesting. The last 20 or 30 years, we've had generally 5, 7, 10-year cycles where growth outperforms or value outperforms. If you look on the left-hand side, you can see, generally speaking, value stocks will trade at, roughly speaking, a 30% discount to growth stocks. That's that long-term average of 0.71. Today, they trade at about a 40% discount. And again, that to us is a bit of an outlier. We think the risk return looks pretty favorable. And so increasing our value exposure somewhat at the margins would be prudent. You can see the idea of companies that tend to be more cyclical, right, have more operating leverage, which means, again, more of their costs are fixed. So every dollar on the top line more or less rolls to the bottom line, whereas companies with more variable costs with less operating leverage tend to have less benefit of that incremental new dollar revenue. The expectation last year, and why a lot of the cyclical stocks did well, was these companies tend to do well in a rising inflation environment. Rising inflation environment is usually a function of increased demand. As demand has waned somewhat, the question is, does it still make sense to have cyclical investments in there? Assuming that this cycle actually is somewhat short, and the moderation or deceleration in some of the consumption will end later this year, early next year, and we see a turn up in consumption, that should really help these cyclicals or these more value-oriented sectors. And so again, it's a case to be a little bit overweight there. Earnings are what drive stock prices, right? So when you think about where we are today, we're in the midst of earnings season. We actually had a pretty good showing from the financials, which are more or less done at this point. We've heard from two big tech companies. Right? Alphabet reported last night really blockbuster numbers. Their stocks up over 6% today. Microsoft's numbers were okay. Their outlook was somewhat soft for cloud, even though the cloud's still growing at 27%, which is like a really impressive number. It just was growing at 31% in the first quarter. So as we look at this year, earnings are pretty much flat in 2023, right? And again, you argue that flat earnings would be unlikely to support higher stock prices. But the market's not thinking about 2023, the market's thinking about 2024 and beyond. And the expectation that earnings will accelerate as we get into the end of this year, right? Earnings estimates for fourth quarter around 7%. And then earnings growth for all of next year is about 10% or so. And really where that's coming from is just an incredible ability for companies to be nimble, right? The technology companies have been talking about this is the year of efficiency, but we've seen it in other companies like Unilever, Procter & Gamble. They've been able to improve earnings really by way of increasing price. Volumes are flat, or volumes might be down slightly, but their ability to grow margins because of their capacity, because of great brands, Coca-Cola, again, just reported this morning, are able to pass higher prices through to consumers. Now that eventually runs out, right? The point sort of someone says, hey, enough's enough, I'm not paying $4 for a bottle of Coca-Cola. But again, thus far, the ability for companies to defend margins, and margins have been pretty robust for a while, has been their ability to really manage costs on the bottom line, but also pass through higher prices or increase prices, to the end consumer. I'll come back to a point I raised before a little about valuation and the case for not just owning all the big cap tech stocks, right? So small cap stocks historically have provided a better return in the long run, right? Makes sense. Take more risks, be compensated, right? The beta is higher. We're now seeing that tech stocks, large cap stocks are as expensive in relation to large companies as we've seen in many, many years, right? So if you go back to prior cycle troughs, whether it was 2002, 2009, small cap stocks tend to do quite well as the economy starts to reaccelerate. Again, it's probably late 2023 or more like the early 2024 phenomenon. But the idea is you're being compensated for taking on a little bit more beta, i.e., a little bit more small cap exposure. But it's important, to acknowledge that not all small caps are built the same. If you look in the upper right hand corner, 41% of companies in the Russell 2000 are not profitable, right? So think biotech, think early technology companies, right? So that number has increased over the last 20 years. It's almost doubled. But if you're buying, more profitable or quality small cap stocks, we do think the risk return looks pretty favorable. And you can see that on this slide here. Again, I've pull your attention to the upper right-hand corner current PE versus 20-year average, right? So the current PE is the diagonal left. The lower diagonal right is the average. And so you can see, again, that kind of value side is very close to its long-term average, but small cap value is considerably cheaper. Small cap growth and to some extent large cap growth are the big outliers there, trading at a fairly significant multiple from what their long-term averages. I'm going to turn it over to Tom now. He'll take us through the international markets. Again, a pretty good showing for overseas stocks. And before Tom gets into the numbers, he's going to share a little bit himself.
Thank you, Jeff, and good afternoon, everyone. Happy to be here. I'm a whole 2 weeks into my Breakwater Capital Group career, so good time to introduce myself. As Jeff mentioned, he and I have known each other for more than 20 years. But to get into first my personal side, I'm married. I have 3 little kids, 12, 10, and 8. So we have our hands full at home for sure. I went to Boston College undergrad, and I live just outside of Boston in Westwood, Massachusetts. I am a Boston sports fan like Jeff. I'm not outwardly enthusiastic, so we don't have to talk about that. If you don't want to talk about it, it's okay. We'll focus on the financial condition and financial planning. On the professional side, I worked at Fidelity for 21 years, and in all different roles. I worked in the managed account group. I worked in a few different branch offices, including the Paramus Investor Center, ending actually in about 2007. I do have my CFP, so I got my CFP in 2005, and I also have a designation more specific to college funding, which I'm happy to talk your ear off about if you're interested at any point for you, your children, your grandchildren, whatever it might be. And most recently, I co-led the branch in the Back Bay of Boston. So right on Boylston Street, across from the Prudential Building, for those of you familiar with Boston. So that's it for me, personal, professional. If any of you have any questions at any point, feel free to reach out. Mostly, I'm excited to work with Jeff and Maddie and just really help run the business. And I also am very excited to spend more time on the financial planning front, helping family, friends, and really my local community, and really all the Breakwater clients that we already have and are very happy to have. So on to international emerging markets and ultimately bonds. And I would say my section of the presentation really is probably further making the case more for diversification and really just looking at why the international markets are important, why fixed income is important. Many of you have probably seen a slide like this. Charles Schwab calls it their asset quilt or class quilt. It's also the Callan periodic table of investment returns, depending on who's putting it together. But with this chart, you can essentially pick a color and follow it. If you look at the columns, it's 2013 all the way through 2022. And if you look at any individual color, you're going to have great years, you're going to have tougher years, and really just by asset class. The big thing is what is the range that they move in. Some assets obviously being a lot more aggressive, some being more conservative. if you don't mind, Maddie, flip to the next screen. So as we look more specifically at international markets, so this is sorted again by the second to the right column. You can see the Nikkei, the index in Brazil, index in India, and then also the MSCI AC World, up 6% for the quarter. Drop down a few lines, you get to the MSCI EFA, it was at 3.2%. It's interesting, if you look under the hood, really in Japan and in Brazil, the story is pretty similar, where unlike the Fed, who's been tightening, both in Japan and Brazil, they've really been more accommodative as it relates to the monetary policy. And that's let the economy and ultimately the markets run a little bit faster. If you look at India, that's actually they've been beneficiaries of international flows. So flows into the country from other countries. And that's at least partially related to increased labor costs in China, as well as just regulatory concerns, if you've seen any of the headlines as it relates to that. So those have been the drivers of much of the international performance. As I mentioned, the case for diversification, if you look at this slide here, really the purple is the EFA outperformance, the dark gray is the US outperformance, and they flip-flop, so there are years, obviously, and sometimes decades, like we've seen, in the past 10 plus years, 15 plus years even, where, the domestic markets have just gone up and up and up. And we've all been beneficiaries of that, which is fantastic. But it is also important to keep in mind, the international markets will go through stretches of time where they will outperform, and sometimes massively. If you look at the late 80s, obviously that was one of the big ones. But even if you look leading up to 2008, right? So 65% over a number of years there can make a very meaningful difference to a portfolio. As Jeff said, 4% span over the course of time is a very significant difference, from large cap to small cap. When you look at the domestic and the international, we just want to be taking advantage of both markets. Thanks, Maddie. And this gets back a little bit to what Jeff was talking about as you look at the little box just above the line graph there. The S&P P ratio 9.4. If you look at the 15-year average, it's at 16. So an argument could be made, just based on the run-up recently, that the market's running pretty hot, domestic market, S&P specifically. You look at the EFA, it's at 13.2 versus 13.6 15-year average. And then, emerging market, a little closer to more like the S&P, it's a little above its 15-year average, 12.1 compared to 11.4. And then as you look at just valuations around the globe, I thought this was a nice slide to illustrate just country by country. So if you look at the bottom of the chart there, and then looking at the blue bars versus the red is the United States, right? Countries all over the world experiencing different economic conditions, some overvalued, the left-hand side of the chart, many undervalued, which is really the right-hand side of the chart. And, the argument is, again, just participation is critical, just to ensure that we continue to participate in a meaningful way within all the portfolios. So the next slide here is really just correlation, right? So sometimes we'll go through a year or a couple of years where it feels like all of our asset classes are moving in the same direction at the same time. And, if you look actually over the last 20 years, the case could be made for the international markets and the domestic markets to be pretty highly correlated. Right now is really the lowest level in the last 20 years that they've been correlated. So, or they're essentially not correlated now. And again, is a great argument to use international markets as a diversifier to reduce overall risk in the portfolio. All right, so on to fixed income. As Maddie said, everybody's favorite topic, interest rates, and what do they mean to us in the fixed income sector and markets? It's actually a good thing, right? Rates have gone up a little bit. we're getting a little bit of a yield on our cash for the first time in a very long time. And really yields on both treasuries, corporate bonds, munis, everything have really perked up, and the benefit of that to all of us is, even if we continue to see increases in interest rates, we get a little bit of a buffer because the yields are a little bit better now, right? So we went through 2022, it was difficult. You'll see that on one of the slides coming up. 2023, there have been some increases, but the Fed has been a little bit less aggressive, pausing in June. And hopefully any additional, at least for the fixed income markets, any additional changes are going to be more moderate. If we look back actually to June 14th, Chairman Powell actually made a comment where, he essentially said that a lot of the interest rate increases have not, the impacts have not actually been felt yet. So I think the Fed knows that, they've raised rates very aggressively. The impacts have not fully been felt, as far as just kind of taking some of the air out of the balloon as it relates to the economy. But, they've given guidance that, they do plan on raising rates, additionally this year and potentially into next year. Matt, if you don't mind, thank you. So as we look at this next slide, the Fed, the interest rates, kind of what, the year-end estimates are for interest rates as it relates to what the Fed thinks, what the market thinks, and then also a long-term projection. What's interesting, I think if in some of the past slides, you could look back a year and say, oh, if you look at a year ago, here's where yields were. It's more impactful, I think, to look back more like a year and a half, right? So if you look at the chart between almost like 2019 and 2021, rates were so incredibly low that there was essentially no yield, no matter what you were looking at in fixed income. And again, because of the rate hikes that we have seen, where it's not great for the housing market necessarily, right? Mortgage rates have gone up very dramatically. It's not great, necessarily if you have a HELOC or, some other variable rate sort of loan, but it is great as it relates to the fixed income portion of your portfolio, as I mentioned, because you have a little bit more yield, a little bit more buffer. As this slide that we have up really talks more about, again, the expectations of the market. So the market is saying, okay, we think there's going to be one more rate change, even though the Fed has really more than hinted that it could be more like 2 rate changes. But then, kind of projecting out into early 2025, well, really 2024 and 2025 to say, here's kind of where we think the rates will be and ultimately what impact there will be on the market. Perfect. And as it relates to this slide, really just the reaction of intermediate bonds versus short-term bonds, which is again, the case for diversification. Often clients will ask us, if rates are still going up, should I take all my bond portfolio and move it toward a short-term stance, right? Should we shorten up the duration and make sure that we're going to be a little less sensitive to interest rates? But it's interesting where, if you read kind of the subheading here, intermediate term bonds have outperformed short-term bonds in the 6 months following the last rate hike, right? So there is a little bit of a lag, a little bit of time passes, but as an ETF or a bond fund or, even just individual bond inventory catches up, you're able to capture some of the additional rate. This doesn't always happen as it relates to where the yield curve stands, right? So if you've looked out to 3, 4, 5, 10 years on the yield curve, you don't get a lot of bang for your buck as it relates to going out longer distances or longer time frames. But historically speaking, again, if we wait 6 months, intermediate bonds perk up, and usually with bonds, it is a little bit supply and demand, and as those rates creep up, the demand will creep up more than likely as well, and that will help to prop up, again, an ETF or a bond portfolio. The real Fed funds rate, really, this is kind of the first time in a while that it's been above core PCE. So that's really the Fed's preferred measurement as it relates to inflation. And so this is an encouraging thing, again, for the bond portfolio to be able to keep up and really even outpace inflation for a period of time. It's fantastic. I feel like, common wisdom as it relates to bonds, right? They're not designed or there to make you wealthy, but they are there to keep you wealthy. And really the idea there is, again, if we can outpace inflation even on the bond side of the portfolio, then that's going to put us in pretty good shape. All right, and next, just the Fed's balance sheet. So we do pay attention, obviously, very closely to interest rates, but the other kind of part of the quantitative tightening is just their balance sheet and how many treasuries the Fed actually owns. And they've been reducing that number and really just getting so that, again, we're kind of tightening on both sides of the equation, the interest rates as well as just the balance sheet. So that shows this. And again, it's something that I think it's going to impact the economy. It's going to impact, just the supply of money, things like that. And it's important to look at both sides of the equation so that we know just how much tightening they're doing. And then as we look at this next slide, right? Negative returns, uncommon in a diversified bond portfolio. We all felt it in 2022. If you look at the largest red negative there, was 2022, down over 10%, almost all the way to 15% there. But if you do look over the course of time, again, slow and steady is your bond portfolio typically, with a few tough years mixed in there. But overall, a positive contributor to a portfolio. Lastly, last slide we'll end on is just the yield curve. Again, if you look at the bottom line there, December 31st, 2021, then you look at December 31st in green, 2022, and then June 2023. So we do see, again, these shorter term yields being higher. As you go out the yield curve, it gets a little bit lower. And, as Jeff had mentioned a little bit earlier in the conversation, that can be an indicator that a recession is coming in some way. It's not a perfect measure. It has been a pretty consistent measure over time. And ultimately, as we look for yield in a portfolio, right now, the bigger opportunities are probably on the shorter end. But depending on what the Fed ends up doing over time, where do you buy along, the spectrum? How do you build your portfolio so you can maximize yield, keep risk low, but ultimately maintain as good of a yield as long as you can if the Fed starts to change their tune and reduce rates longer term.
So everyone's favorite topic here you can keep yours on, that will end on asset allocation. So it's great to be informed in the short term. We know that the market really rewards long-term behavior. So what does this all mean for you and your portfolio? We want you to know why you own what you own and what that means in terms of your portfolio getting you to your goals. So if we look at expected asset class returns here, so after a very good run for 10 years, the next 10 years, might not, or is probably not likely to be as spectacular, but 6 to 7% for equities, whether that's domestic equities or international equities, is certainly better than 3 to 5% between cash and bonds. Really furthers why continued diversification makes sense. We would expect investors to moderate their expectation moving forward for the next 10 years for equities. Equities, like we said before, are meant to be held for the long term. So, we're not looking to get big numbers right away. The market rewards long-term behavior, and those types of investments are meant to be kept for 10-year timeframes, not 1 to 2 year timeframes. So, we want a portfolio that we know that is reflective of our goals and not because we're chasing returns. Chasing returns, really leads us to chase greed. And it's not something we're going to be rewarded for. So if we look at, why diversification is important, just sort of furthering this case, This slide shows how a balanced portfolio has held up compared to that of an all stock portfolio, and how the performance has been over time versus how it performed during severe market pullbacks from 2000 to 2022. So you can see the tech wreck from an all stock portfolio, down 39%, the classic 60/40 portfolio down almost half of that. So it's losing, 50% less. Financial crisis, losing 20% less there. All stocks down 51%, 60/40 portfolio down 31%. We heard a lot last year about how the 64-week portfolio might be dead, but we can see if we look at that period of time last year, that might not necessarily be true. Stocks down 24% last year. That 60/40 portfolio, although it was a rough year, definitely because of the fixed income piece, adding to this negative return, but it was down, 20%. So still, hopefully this shows why we continue to believe that diversification is the only free lunch you're going to get in investing.
Thanks, Maddie. Yeah, and folks, we don't want to make it seem like we're overly pessimistic or bearish as it relates to the long run. We're very much optimists, and I think that the next 10 years we'll look back and be happy about. I think part of this also gets back to like portfolio construction and being thoughtful. Again, if you're looking at like the S&P, knowing that it's been up 13% a year since pretty much the end of or for the last 10 years as of the end of June, or 16% per year as the end of 2021. Yeah, tempered expectation makes sense. But if you can say, hey, I'm not looking to just track the S&P, but I'm going to be thoughtful about incorporating things where the risk return might be more attractive, you should look to perhaps outperform those expected returns at the macro level. This is really kind of a neat slide to me too, right? So again, you look bear markets and bull markets. Bears are in pink or red. Bulls in blue, and you can see bull markets tend to be really, really long, right? We're in the midst of hopefully a new bear market, a bull market, excuse me. There's some question about is this a cyclical bull or secular bull? If you look back at in the long run, secular bull markets generally are about 18 years, right? This bull market started in 2013, so that would stand to reason that you have another 7 or 8 years of the bull in front of us on a secular basis. Again, independent of whether or not the history plays out, it makes sense to have a lot more money in the market in the long run, knowing that those bull markets tend to be much, much longer. 70 months versus 14 for a bear. And then, just again, speaking to, he or she who loses less, frankly, has more ground to make up. It's important to understand that when we see these bull markets, kind of come back in favor, they'll do a good job of picking up for those losses we saw just in the last, or the 10 months of 2022, right? From January to October, the market dropped around 25%. Knowing that we're again within 5% of the market's all-time high, the retrenchment's been pretty quick. And you can see on the left-hand side, again, 9.4% would get you back to the 4,800 level. If we get that next year, if it takes us 2 years, we might average 5.4% for cumulative return 11.1. Still not bad. I'll be happy to take either one of those scenarios. That'll round us out for some of the slides today. Let me just hit on a couple of key themes. Inflation's clearly peaked. You saw the heat map, right? Looking back to June of 2022, a lot of red on the screen. Now we see a lot more in the way of green, light green, and maybe some oranges. Rental car prices continue to be somewhat high. We're seeing a little bit of impact of owner equivalent rent, right? Which is a way of gauging home prices. That should start to roll over in the back half of this year and into next year as it relates to inflation measures. A soft landing still is very much a possibility. I think a recession, the odds of are still higher than they normally are, which again should make sense when the Fed's been stepping on the brakes. But there's no assurance that they will have this recession that's been kind of talked about for now 18 months. And why that's the case, labor trends are really, really solid, right? We've got, and there's actually an article today in the Wall Street Journal. I'll get probably this email to me from Maddie in a couple of hours to talk about the 4-day work week and how productive that's been. And so as we continue to look at some of the benefits of a healthy labor market, that's going to continue to propel or prop up the economy. Again, market's fully priced, so look for the things that maybe haven't worked as well or are still working but just not capturing headlines. Interesting enough, like we heard a lot about that notion of market breadth. and that was bad breath, right? Because those 7 stocks or those 5 stocks were contributing so much to the performance. Since the middle of June, we've really seen a broadening out, and the participation of pretty much all sectors have been really, really good to see, right? So we hope that continues as we march through the rest of the third quarter and into the fourth quarter. And I would say, back to Tom's point about interest rates, right? Like, and I made this in a note we sent at the end of last year, that the opportunity set for investments looked a lot more attractive on December 31st of 2022. I can say wholeheartedly for the next 10 years, fixed income returns are going to do a lot more to help your return, right? Versus the last 10 years when they averaged pretty much nothing, right? So again, range bound rates, not a bad thing. Don't expect a lot of price appreciation in fixed income, but that never should have been the case. That happened for 40 years as we took interest rates from 22% down to 0. But if interest rates kind of hover in these, 3 to 4%, 4 to 5% territory, that can be a good thing for a part of the portfolio. I will say this, we're going to open up to Q&A in a minute, take some questions, and we have a few, but we're also going to send a formal survey out, our first survey. Informally, please send us feedback. We're happy to take emails right after the meeting today or over the next few days, because that's valuable to us. But we'll send that formal survey out to really kind of capture, your sentiments. And we appreciate all the trust you've given us over the last year. And we look forward to these continued events and you giving us your valuable time. Thank you so much. Maddie, again, you want to take the cue from the Q&A?
Yes.
Sorry, looks, well, in the spirit of time, we're a little bit over. A couple of these questions might be a little bit more specific to clients themselves. So we'll take those offline. Folks, again, thank you so much for the time. Be on the lookout for the email with the content. If there are specific slides that you want to see or see more of, feel free to reach out to us. Some of the information is proprietary, so we can't send the deck that it came from. But again, really privileged to have the opportunity to invest on your behalf. And just thank you so much for continued trust.
Thanks, everyone.